Welcome, everybody. Bob and John here. Wanted to touch base with you on our second quarter economic update. There's been a lot of things going on in the world and the markets, and we want to update you on what we're thinking and what we're seeing. So with that, Bob, do you want to go through a few charts and I'll interject as we need to?
Sounds like a great idea, John. So let's start with just kind of looking at what markets have done, not only this year, but what markets have really done over the last year or last year and a half at this point. We went through a very difficult period between COVID and Russia's invading Ukraine and multiple other issues along the way. But we bottomed out in last October of 2022. We rallied 50% since then. Pretty impressively rallied that. Of course, we during this time kept reiterating we did not see the recession that most people were seeing. Fortunately, the recession didn't come, and markets rallied. And now, not surprisingly, they've taken a little bit of a breather. And I think there's two reasons why they've taken a breather. I would argue that the primary reason is that they probably got a little ahead of themselves, and that the Fed is not going to cut interest rates at the pace that the consensus previously expected. But yet, if you go out on the news, you listen to financial networks, they're pinning a lot of this on the current Middle East crisis between Iran and Israel and all that. But so I do let's talk about that just a little bit. Geopolitical events historically have been very good buying opportunities. And, I don't want to just say that with an absolute, dismissive tone of, well, when things go bad, you just buy, you should buy on these dips. Like, things can always spiral out of control, and they certainly have. If we go back and we look since, the last real major bear market we had, I would say it was 2008, 2009. That was not a geopolitical event. It was an economic event. Specifically, it was a credit crunch caused by the CMOs, collateralized mortgage obligations, et cetera, all that structured finance that created this enormous credit crisis where people were way over leveraged. It was an economic event, is why we crashed in the 08, 09 period. And then we rallied through that. But through that rally, we tend to have recency bias and forget about all the different concerns during that period, everything from North Korean nuclear weapons to disputed elections to social unrest to there's countless things that happen along this way. But ultimately, if it doesn't come through to the economics, the stock market tends to be an unemotional character and move forward. So we can see that despite all of this, the market has moved forward. The reason why the market has moved forward is because corporate earnings continue to grow and the economy continues to grow. And that is what you're buying when you buy stocks. You're buying a percentage of those corporate earnings. So if they grow, your stocks will likely grow in price too.
So in addition to the geopolitical events that we talked about, I think the market's also worried a little bit about the Fed and where interest rates are going. So this chart is talking about the Fed's interest rate target. Bob, I'll let you expand on this a little bit.
Yeah, so this first chart we have here is simply the Fed funds target rate. This is what, when you read the Fed minutes, the Fed does no shortage of talking, but Chairman Powell in particular, this is what they're referring to. They have the short-term rate at 5.5%. That's their target rate, raised up from almost 0% for during that post-COVID period, and really since the 08 financial crisis of zero interest rate policies. They tried to boost it a little bit, get things going a little bit in the around 2017, but didn't come through. So that's where the rate's at. Now, this chart, what's interesting about this chart is if we look at that's the blue line that we were just speaking about is still there, right? That's the target rate. There's something called the Fed funds future. So what it does is that just looks ahead 12 months. It's the futures market, and it shows us the expectations of where the consensus expectations, right? Because there's buyers and sellers. So this is the equilibrium where people think rates will be. And we'll notice that at the late 2023, early 2024, we saw the expectations drop dramatically. That so far, over 150 basis points, people were expecting about 150, that's the red line on the future. We're expecting the Fed to cut 6 to 7 times up to 150 basis points. That was the expectation. And then all of a sudden we see over this last couple of months that line starting to go back up. People are now not expecting the Fed to cut as much. And the reason is twofold. One, they've mentioned we keep getting hotter than expected inflation numbers. I'm going to talk about that in 1 second, but I would dispute that. But two, the Chairman Powell said they do not expect to cut rates as frequently, and several other Fed governors have also said that, and we're in agreement with that. If anything, the economy is getting a little too good, a little too fast, and there's no reason to create a further bubble in the economy by cutting rates needlessly, just to let them stand where they are.
Yeah, as Bob was talking about, this chart here is showing what we use for GDP forecasting. Is the Atlanta Fed GDP now is a metric that tries to pinpoint exactly where the economy is going immediately. And what we're still seeing is strong economic growth. Bob?
We are. I mean, the much promised recession of 2021 that went to 2022 and then went to 2023 and never happened, is now, 2023 final GDP numbers came in at 3.1% for the year. Those are, above trend growth rate. And we see the GDP now is at 2.8% now for Q1. Again, that blue line there is the blue chip consensus. These are the top economists, what they're expecting. So the economy continues to outperform economic expectations at the aggregate growth level. So yeah, the economy is doing fine, and this is just really important. I say so for all the complexities of the stock market. This is what it is. The stock, when you buy a stock, you're buying a percentage of that company. 1/1,000,000th of 1% or whatever it is, depending on the stock you buy. So what you're buying then is effectively a percentage of their earnings, right? You buy something because it's going to generate earnings in the future. We discount those future earnings back to the present value, and that becomes the valuation of a company. So you can see the red line extends just a little bit beyond that blue line. The blue line are actual operating earnings. The red line are forecasted operating earnings. So you'll notice that analysts, things called IBIS, which is an aggregate of all these sell-side analysts, Goldman Sachs, JP Morgan, etc. This is what their average expectation is. You can see those expected earnings keep rising. Well, if expected earnings keep rising, stocks tend to keep rising. And so, that's what's been going on with the market, is that not only has GDP growth exceeded expectations, but corporate earnings growth continues to exceed expectations. And that is why stocks have been going up. We think when we look at these operating earnings, and again, operating earnings takes out everything except for the actual core business. Our expected operating earnings is actually higher than the consensus. So we think there's still upside surprise to actual earnings as they come out, will likely beat the consensus forecast.
So if I were to summarize, we've had a very good start to the markets this year, actually a really good finish last year. Despite the short-term focus on what the Fed is going to do and the geopolitical events that are affecting the markets in the last few weeks, we still see the economics of the United States very strong and see positive growth going forward for portfolios really for the next year or two. So with that, appreciate everyone's time and listening. Always feel free to call either one of us or anyone on the team if you have any questions, and we'll touch base with another video in the third quarter. But all of you, I hope you have a great summer, and we'll be in touch. Thank you.
Thank you.